using one standard deviation. And in this particular event, I will be discussing various facts of the one standard deviation analysis. And this, I will start with the trend analysis of benefits of this and how you can form option strategies based on this particular analysis. And third, I will be taking you how you can estimate the most probable trend for Monday using this one standard deviation concept. So before going into this one standard deviation concept, I'll just take you across some of the basic trend analysis procedure. So these are the procedures traders used to follow, and many times I have taken up this basic trend analysis factor with the traders. And many of my video lectures, whatever you will find out in the YouTube, it also covers that. So the first focus I'll take your attention to the PCR, put call ratio. Put call ratio, this many of you will be knowing this concept, but how to use this particular parameter for your trend analysis, that is very important. And as far as Nifty study is concerned, Indian markets Nifty study is concerned, and the historic facts, whatever the Nifty has given so far, because every stock or indices having different PCR. But when for many years, every time it gives PCR, and based on this PCR analysis, how the trend, the future trend used to or be, or how the stock used to behave based on the PCR. If I look into this Nifty studies, so this PCR says that whenever this 1.16 above, this PCR remains, the Nifty maintains a uptrend. Whenever the 0.85 below the PCR maintains, then the Nifty maintains a downtrend, and from this 0.85 to 1.05, this is known as your range bound zone, or 0.95 to 1.05 is known as your range bound zone. So in this range, if the PCR maintains, then the Nifty used to be in the sideways movement. So this I have already told to you in many other videos. So how to calculate the PCR at any particular time? Total number of put contracts available in that market divided by the total number of call contracts available in the market. So that need to be divided. So if you divide both the things, this is the put contracts and this is the call contracts. Little bit I will increase the size of this font so it will be more visible. So this is the put contract and call contracts. So I am just dividing the number of open interest in the put divided by call, and this is giving you put call ratio 1.17. So this suggests that the Nifty is in the uptrend. So Nifty is in the uptrend based on this put call ratio analysis. Again, I will draw your attention to the open interest of different strikes. So here this says that this is the right hand side is the put side, left hand side is the call side. So this right hand side represents all the put strikes, and this is the left hand side, it is call strikes. If you see the open interest of this 9,400 strike, 9,500 strike, also 9,600 strike, all these strikes is having the highest open interest best as compared to other strikes. So this suggests that these are the strongest support for the Nifty in the downtrend. Same way, the 9,700 call having the highest open interest, followed with 9,600 call. So this suggests that these are the resistances for the Nifty in the near term. So here one question comes, whether the resistances are superior at this point of time or the supports are superior at this point of time, because I'm telling about the 9,700 is having a highest open interest and 9,600 also having the highest open interest. Similar way, 500, 400 and 600 also having the open interest in the put side. So looking into this, whether the resistances will be encountered fast or the supports will be encountered fast in the price move. If I ask a plain question here, whether at this particular time the price action will meet the resistance points and it is relevant for the studies, or it will meet the support points and it is more relevant for the studies. So if I give you these two choices, then you must draw your attention towards the open interests of the call option and put option and compare them. So support side put options having the highest open interest as compared to the resistance side call options. Support side put options are having higher open interests as compared to the resistance side call options. Henceforth, the price action will be more vital for the resistance side, because resistance side you have lesser open interest as compared to the support side. So this is also a very important fundamental understanding on the market you can make. So this is also one of the very important fundamental understanding you can make for the market study or the trend analysis. So these are the fundamental study why I used to say, because based on this particular open interest or put call ratio, you cannot derive a proper trend analysis. What is a proper trend analysis or a progressive trend analysis? I must come to a point, I repeat, I must know a price point from where the uptrend will give me a breakout. I must know a price point from where I should get a downtrend breakout. That is very important for me. So very many different studies are available for analyzing the trend. You have moving average, you have oscillators, you have WD Gann study, you have Elliott study, many studies are available. So here in Smart Finance, in our company or in our method, in Smart Finance method, what is the difference we brought into this trend analysis? We have never changed any technique. I want to make it very categorical confession here. We have never ever changed any technique. Rather, we have enhanced the capacity of that training, the capacity of that particular method by introducing few facts into that method, or by infusing some concept into that particular method. So our core concept is the volatility, and we always trust on the real-time volatility. When I talk about the real-time volatility, that is different from your historic volatility. Suppose if you just go to the NSE site and you just look into any derivative instrument, say Nifty, you are just going for the Nifty. And once you go for this Nifty and under this other info, you will get one volatility factor. Annual volatility, this is daily volatility. This is historic in nature. Historic in nature, why? Past 365 days, whatever the prices it has made, it is being recorded, and there is a logarithmic process by mean of which logarithmic process you get the variance and square root of variance that gives you this volatility. So here question comes, maybe the price action was different in the beginning part of this 365 days and this price action was narrow in the end part of this series or this 365 days. Hence, by taking this reading for past 365 days, whatever the volatility I am getting, that is not the real volatility. the volatility which is presented in front of me is not the actual volatility because it is being manipulated by the older data. So when I talk about the real-time volatility, that makes a great change to the fundamental attribute. So real-time volatility cannot be explained through a basic mathematical process. It can be done through a logarithmic or a logical process. Many methods are there to calculate the real-time volatility. One is a Garch method, Garch, and also there is a method called Arch. So Arch method. So these two methods are basically used for calculating the real-time volatility. And we have brought some fundamental changes to these particular methods to derive it, and that we kept as our core of all our software solutions. And this is one of our copyright secret, as I used to mention all the time. So here you are getting an annualized volatility of 10.83%. However, the software what we have developed, it is getting one real-time estimation of volatility at 7.93. Some people used to ask me, you are giving this volatility estimate on Friday and you are telling it is valid for next week. So how come? You are first of all, you are telling it is real-time in nature. Second, you are contradicting your fact, saying that this volatility I am giving on Friday and it is valid for next week. Means you are giving a historic definition to it. So many people have expressed their feelings on that, and you have many of you also written me the email about that. So here, this is a real-time volatility. However, there is a forward progression in this. When you derive the real-time volatility, there are three factors associated with that. One is a forward progression. Second, current progression. Third, past progression. In past, what are the things has happened? Based on that, you are estimating. Current progression means currently whatever the actions are taking place, based on there is a calculation. And forward progression, in the coming few days at the line, how the volatility will be. So that is a entirely different subject, and we have simulated a great mathematical model to derive these things. And we have derived this forward progression method. So it is not historic. It is a real-time volatility based on forward progression method. So that's why this is also a real-time volatility. That's why you used to get some experience that based on this method, whenever any trend is getting calculated, precisely it hits that point and trend reversal happens to a very precise point. So this is a forward progressing volatility. And once this volatility is derived and the remaining calculations are too simple, I need a reference point from where I should start my calculation. So I am taking the last traded price of that instrument. Nifty 9645, this is the last traded price of the future. So you may ask me, last webinar also I have told you, why I have not taken the day's high, why I have not taken the day's low, why I have not taken a midpoint of a high and a low, why I am taking the last traded price? Because here I want a reference point only. This price point is just a reference point from where I can start my future journey, or I can trace my future resistance and supports. So if I take a day's high or day's low, it is a far history point as compared to the last traded price. Once the day starts at 9:15 and ends at 3:30, so which is your recent past or far past point? So the last traded price what is being triggered at 3:30, this is the latest historic point, price point, as compared to day's high or day's low. Henceforth, I have taken the last traded price for the trend calculation. And coming to the trend calculation, once I have taken the Fibonacci ratio, it will be too easy. So I have just taken the real-time volatility place it in the one standard deviation formula. So this formula was present before, it is also present now. So I got a price range 106 point. Using this 106 point price point on this Fibonacci ratios, retracement ratios, I'll get the different retracement price range. Just I am adding with the reference point and subtracting from the reference point. I got the resistance points here and I got the support points. So then I will be following the Fibonacci principle because Fibonacci retracement I have used. So what Fibonacci principle says? Anytime price moves above 0.236 retracement, it sets the trend. So trend having two parameters here, trend set point and trend confirmation points. So same way like your trend set point and confirmation point, you also have a trend reversal points. So these three technical parameters clearly understand, and this is common for all method: trend set, trend confirmation, trend retracement. So, or the trend backward movement. So these are the points based on the Fibonacci. When the price move above or below 0.236, it sets the trend. It sets a uptrend or a downtrend. Once it crosses 0.382, it confirms. Once it confirms, then it comes to 0.618 to 0.786. In this particular band, there is a maximum probability of trend reversal. Trend can come back. A trend can take a pause here. It wait for some time, then it can, based on the demand and supply analysis, it can move forward. So this is the trend set, confirmation and retracement points. So as per the Fibonacci. So once this study is completed, so you got a clear-cut answer for your trade or your trend analysis. This says whenever the price move above the 9670, your trend is up. It get confirmed once it is 9685 above. Once it covers this, it will come to this 9710, first target. Here one retracement is possible, or there is a pause period, it's a waiting period, it's possible here. So post moving above this 9728, which is very critical for this move, it can move beyond that, and it has a last target for this 9816. So this is not the final target. This is one cycle. So 0.236 to 1.618, it is one cycle, one process. Once this one process is ended, the second process will start, third process will start. So three different cycles it can move, or maximum if there is a great demand, then it can move till 5 cycles. So this is the trend analysis we got. Once we got the trend analysis, then we have to implement this trend analysis in your trading practice. So when we trade based on specific practice, some people used to put a stop loss and come out. Some people used to hedge it with some options and initiate a trade. Some people used to protect to the maximum and trade. So different styles are there. So easiest style what I have told here, if Nifty crosses 9670, that is uptrend price points, then buy it along with one put option 9650 put option, and if it hits the first target 9710, trail your stop loss to 0.382 level, which is 9685. If it hits the second target, that is 0.786 target, so revise your stop loss to 0.5, 9698. If it moves to third target, trail your stop loss to 0.618 level. So go on trailing till you have not achieved the final target or the trailing stop loss is not triggered. This you can go on trailing. At one point of time, if you are satisfied with the profit, you can better close it and come out. There is no need to wait for the final target also. That is your choice. And if the same way the downtrend breakout gives, then you sell the Nifty future along with one call option purchase. This is the simplest hedging we can implement. Beyond that, we have many complex hedging methods also. We can do very complex hedging methods. Some of the hedging techniques also I'll tell you during the course of this today's webinar. So if you're selling, you buy a call option and hedge it. So many critics are there for the hedging. Some say hedging is difficult. Some says that hedging reduces the profit. Some says hedging is not good for the trade. Many critics are there, and some says that hedging is good for the trade. So I am in the side of the good part of this hedging. Hedging no doubt reduces the profit. Same time, it also reduces the losses on your failing trades. Whatever the method we apply, no method can give you 100% success. This you have to keep in your mind. As a trader, you have to be very clearly keep this fact in your mind. No method in this world give 100% success. If there is an amount of failure, say 80% success, 20% failure, 50% success or 50% failure, whatever the amount of failure is there, if 50% of your trades are failure, if there is a hedging component associated with that, you can reduce your losses to the extent of 80%. If 50% of the trades are failed and 50% of trades you are winning, on these failed trades, whatever the failed trades, if you hedge it, then your losses on that will be almost 80% lesser as compared to a non-hedged trade. Henceforth, hedging is highly important. It makes you a mature trader, it makes you a rational trader, and it makes you an ethical trader. So no trade you should initiate with compulsion, with fear, with anxiety. If you hedge, your fear factor is managed, your anxiety is managed, and you can do a peaceful trading. So hedging is very important because you are going to trade means in the stock market, your business is speculation and you wish to earn money from speculation. When you wish to earn money from the speculation, then two things is very important for your activity, or two things is very important for your profit making ability. One, the trend analysis method which you have followed, that must be true and it must be successful. First thing, if you whatever hedging badging you apply, but if the way you do a trend analysis or the method you follow for trend analysis, if that method itself is not successful, then how it will give you the success? So your majority of loss side will be there. So your method of trend analysis must be solid, it must be proven. First thing. Second thing, you must hedge. You must hedge. This instrument is being given for hedging. So this is the principles of hedging you can implement. Simplest principle is whenever you are buying a future, buy a put. Whenever you sell a future, you buy a call. So the nearest strike is the preferable one. And always the buying of the options also is not advisable. Sometimes you need to sell also. That is common to your complex option strategy. However, this is the simplest technique, and based on this simplest technique also, many have got excellent profit out of this method. And so far this one standard deviation method last week I have not given because of some technical difficulties. If you compare past 83 weeks, we have been giving this one. This is the 84th week we have given. Out of that 75 weeks, it has given the success. There is an amount of failure. So this success is amazing. It's a great success. So it's a great success. And whenever, that's why I used to say that one method of trend analysis is very important for your success. Now, same way, if I go back to the Bank Nifty for the coming week, the Bank Nifty trends are given here. So 23,427 above, you can set an uptrend. 23,247 below, you can set a downtrend. If uptrend, it has the maximum probability till 23,700, downtrend till 23,000. And here too also you hedge it with the options. and hedging the options, different techniques you can apply. Fine. So this is how you can analyze a trend and enter a simplest trade. But here thing is that I just want to do something more using this particular method. I'm not satisfied with this particular one small trade of using a future long along with a call option or put option. This sounds simple, and same way it also having an amount of failure. So here I just want to do something more in this. So here I'll just draw your attention to another part of your study. Whenever you do some option strategy trade, wherein you know your risk, you know your reward. So when you initiate some option strategic trade, that time also this particular method helps you a lot. So simple example. Suppose Monday market opens and it is opening above 9670, below 9685. This range it opens. So you have a view that definitely it will go to the 9710 because uptrend breakout has given. So nothing wrong if you can buy one 9700 call option at this point of time and sell a 9800 call option at this point of time. So you must say that why, if it is uptrend I can buy one call option, it is your wish. But that is not a hedged position. Suppose you are buying at 70 rupees this 9700 call option, or 75 or 79 rupees. So if you buy only call option, this 79 rupees is exposed to the risk. You do not have any hedging. You cannot protect this. It is a non-protected 79 rupees you have thrown into the sea, and you have to search. If that money is grown, you can get it. If it is not grown, whatever the decay has come, you have to accept it. However, as a hedger, as an option strategic trader, what he'll do? Uptrend has given, definitely buy a call option. Same time, I have a fear. Maybe this uptrend is a failure and it can come down to the 9620. So I can think of a 9800 call option sell. So once he buy at 79 and sell 9800 call option, say is selling at some 35 rupees or 36 rupees. So it's reduced its loss risk from 82 by 35 rupees. So here the risk reward comes here. So 4 and 73 as 4. So if he loses, he can lose maximum 44 point, and if he wins, he can get 56 points. So reward is 56 point maximum, loss is maximum 44 point. This is how you can form option strategy looking into this parameter. So just do not concentrate on this basic strategy. Here two very key questions of yours is got answered. So this particular strategy is whatever you can say, it is a bull spread or whatever maybe, call spread, bull spread, whatever name you want to give it. This trend analysis given you the idea, or this particular trend analysis given you a clear-cut indication. Once the uptrend confirms, I should take a bull spread, call net debit bull spread in call. If the downtrend breakout given, then I should take one net debit put spread strategy. So based on the trend, you have categorized the strategy and you have categorized the strike, which strike to take and which kind of strategy to take. That two idea it has given. If just forget this trend analysis, without this trend analysis you are in dilemma. Some people will say that okay, buy this call option, sell this, also go for a put. So both the sides you are there, you are ignorant about the trend, you are ignorant where the trend is going to mature, or there is a reversal in the trend. So with all ignorance in one side, if you hedge or form an option strategy, then that is bound to fail. If you are ignorant about the trend, if you are ignorant about where the trend reversal is expected, And if you follow a neutral market strategy, then you are bound to fail. There is no problem in your strategy formation. The problem is you have just forgotten the very basic definition of strategy, why I am taking this strategy and what has prompted me to take this strategy. So that is very important. So if you are interested to learn more about the strategy, which kind of condition I should take, which kind of market condition, what kind of strategy I have to take, and when to take one strategy, then we have a fantastic course also. You can go for our futures and option course, which can give you a great deal of knowledge in the option strategy. How to implement the option strategy you will learn. Saddle, strangle, God condor, everybody knows. Everybody knows the iron condor, saddle, strangle, God condor, all these things, 35 basic strategies. How to implement that strategies, that is very important. So that is very important, and that we give in our course. All our courses are practical oriented, which gives you when to use what technique, when to use what strategy. Only thing it is required, you need to study it. It is a ready-made course. Multiple times you have to go through those video lectures. Multiple times you have to read through the printed book which is being written by me. So fine. So this is about the future and option course I have told. This is one of the analysis. Little bit make it complex. Little bit make it complex. So you have seen just now, there is a put call ratio. There is a open interest analysis in the first part of my analysis I have told. But one more thing, if you just look into this particular option data of NSE side, you are seeing the implied volatility. Here, this is IV. So this is not calculated by me, this is by the NSE. IV of these call options are 4%, 5%, 6% maximum, 8% maximum. Compared to this put option, it is 12%, 13%, 14%. How come? What inference I can draw from there? One side having a great implied volatility, same expiry, other side having a very low implied volatility. What inference I can draw from here? Many of your theoretical books will never cover. If you ask your analyst why this kind of phenomena is there, he said that it is there, it is just calculated value, it is coming there. That is the answer you can get. But it has a great meaning. It has a great meaning. If you have got my email today, which I have transmitted around 12 o'clock, no, I have given a great thought about that. Very low call option IV suggest a range bound market or move in a small band. I have given it. If any of you have got it, this says that very low call option IV as compared to the put, whenever you encounter, this says that you are in a range bound market. You are in a very tight range bound market. So when you are in a tight range bound market, so based on this particular analysis of ours, one standard deviation, I used to give a range bound things whenever the price move only in this 0.5 level from 9697 to 9592. This band, once the price moves, it is a range bound. But we need to take a median. Median means from where we have taken. So as long as it maintains above 9645 and it retraces from 9697, I can say that it is uptrend range bound. As long as it retraces from 9592 and it again find a resistance at 9645, I can say that it is a range bound in the downtrend. This is a very basic definition of Fibonacci. It is nothing to do with my studies. So here, just moving little bit more forward. What I have written here, I have given you 1SD analysis suggests a small band of 9400 to 9738 with a median of 9570. This too also is a great study of our one standard deviation. So these price points of 9400 to 9738, it again comes from a real-time volatility analysis. Considering a fact, in the past 1 week, Again means draw your attention to this point. Draw your attention to this point. I have given 9400 to 9738. Median as 9570. This median point is nothing but as per the real-time volatility analysis. From where we are getting a trend reversal. When there is a downtrend, where is the most probable price point from where we can reverse? So this is the median point. Median definition as per the statistics. If you are a student of statistics, if you have studied statistics, what it has said in a data set, in a random data set or a random population, the data which present maximum time is known as a median. In a random data set, if you have taken some 1000 data points or 5000 data points, data point is nothing but your price points in capital market terms. In a random population, the population which present maximum time is known as your median. This is what it is told. So here how the random population you will create? You must tell me, because every time some price is happening. We have a great study along with this technical studies for capital market. We have a Monte Carlo simulation method. Many of you would have heard about that. Monte Carlo simulation method for stock market. This also, if you have my WD Gans method book, any one of you, if you are having the WD Gans method book written by me, there also Monte Carlo simulation method I have explained under the 34 intraday trading technique segment. This Monte Carlo simulation method, based on this Monte Carlo simulation method, using a probability factor, you can create millions of price points which is most likely to happen on the chart, and from that price point you can derive this median points. There is a mathematical process along with that. So this also belongs to this same one standard deviation studies fraternity. So if you can a little bit concentrate on the Monte Carlo simulation method, you can get a median point. Median point is very, very important for your trend analysis also. So specifically when there is a market is expected to be range bound, you must know the median point. Fine. So this is all about the studies. And when you come to the Smart Finance, many of you are registered with us. Many of you are getting our weekly trend report, downloading it week on week basis. Sometimes we discontinue that things because of technical difficulties, or sometimes because it is a free report. Sometimes we have to create some disturbance in the pattern, so that we have to stop it at one point of time, because forever we cannot able to give it for this thing. If you have our software, you can very well generate those reports on your screen. So just use the number of days as 7, positional option, click it, you will get the same values whatever I am sending here. Same values, not even 1 paisa difference you can get. You got here 9669.99. So software has created this one, 9669.997. So this is what you will get. Software, if you have, you can easily create it. So basically in the Smart Finance, what is our aim for a long period of time? What we want to convey to the traders? Our establishment is 10 plus year, means 11th year also we have completed. So 2005 to 2017, this many of years we have given. Consistently we are present in the market. We are not a flyaway company. Many tech advisors or tech stocks companies, address also you will not find out in their website. They do not have an address. They won't give. They fear. They fear to show their address. But our consistent present, many of you have already failed. Our main aim in this particular journey is we should bring some quality research and unique research in this line, so it will benefit the traders. That is our first aim, whether you accept it or not. This is our true aim. Second, we always focus on quality studies. These are the studies, whatever you found out, one standard deviation or Gann angle volatility or any of our studies, it is unique. You won't find it in any other book. So definitely there is a contradiction. You have written something in some book. Why should I read? So here, writing something doesn't make it a unique as long as it has not been translated or it has not been implemented and it is not working. If you take about beta decoupling, if you take about one standard deviation, if you take about our GAV, gain angle and volatility, these are the technique so far anybody has used it and they have not contradicted. They have never, so far many thousands of people have used it. In basic form also, those who have used the volatility trading technique. So many of you would have tested this mathematical technique or some or other form. Nobody has told me that it has never worked. It works. Yes, we have enhanced in the software. It has a different experience. When you use the concept in the crude form, different experience. In crude form, I used to say it will give you some 40, 50%, 60% accuracy. Some says that no, it gives little more. In software, we say that 70 to 80% it maintains the accuracy. It proves beyond that. So here, these techniques, when it has been innovated and implemented in the market, it works. So this makes this technique as unique and it works. So you must ask me, there are many technical studies was there, then why I have chosen a new path? Why the same technique cannot be followed? Most of the techniques, whatever was present in the market, all those techniques were statistical in the nature. And those statistical things having a limitation, as I have told you, by taking 365 days data, if you derive the volatility, it is 10 point something. Actually, it is 7 point something. So statistical studies have this particular limitation. Henceforth, its accuracy is restricted to 50 to 60%. So that was the need for me to think beyond that part, and we have brought some concepts. So if you are a learner, if you wish to learn those techniques, you can opt for our full package, which covers all our studies in the different books, printed books. 6 printed books we have, 16 DVDs we have explained those concepts, and based on using those concepts, means we have translated those concepts into the software form. You can very well use it. So based on your interest, you can go for that. It comes with a package cost of 17,500. And one standard deviation software available in the Android app form and in the desktop form. If you wish to, you can purchase it. Desktop, it costs you 2750. Android app, it costs you 3000. All queries, sales related queries, you can ask here. So here too, I have just recommended today some of the option strategies. 2 strategies I have recommended. One is a 5/2 call spread. Another is a simple cross calendar call spread. This is based on my analysis on one standard deviation and trend. Because I never arrest myself, because everybody is the slave of their own experience, and I never arrest myself by saying that yes, this is the thing I am looking and it is bearish, market is bullish. So those vague concepts I never ever used to trust. So this is the analysis I have done. I am not God. I do not know where the market will open. On Monday, if market opens at 9670, I will be a confident bull on the market. If it opens below 9620, I will be a confident bear in the market. And once I am bull also, I am not surrendering to my bullishness to the 100%. I am hedging my bullish position, thinking that and thinking the fact and truth that the bullish nature what I am experiencing, it is not for lifelong period. It can change at any point of time. Or the bearish nature what I am experiencing, it is not going to stay forever. It is going to change at any point of time. For that I am hedging it. So hedging is must, trend is must. Based on the trend breakout, you need to accept the trend, any method you follow, And one point of time, once the trend matures, you need to reassess your view. So this is how our analysis goes on. Any questions in this discussion subject, you can ask me. Regarding the product also, I have given a brief explanation what is smart finance products are and how you can take benefit from the smart finance products. And this week's trend report is already given in our website. You can download it from the download link and follow it for 1 week and then experience and say how it works. If you go to this product page, I have given a very categorical and clear understanding on this particular product. So if you just go to this particular page and if you just download this PDF, here very clear instructions are being given. So how the software look like, how to use this software. So the question what Mr. Nainas Mokwanais has asked, what is cluster? So this too also is being explained here. First part, Fibonacci definition of Fibonacci cluster I have given here. And many of you, what time I should take these things, that also I have explained here. So with example, it is being explained here. So if you just download this particular document associated with this particular software and read through it once, it is clear what is this tool is.